I want to welcome Michael Oliver, who is the founder of the proprietary technical trading strategy called Momentum Structural Analysis, and it has accurately predicted many trends over the years. And I'm excited to speak to you, Michael, because I want to see what you see now.
Okay, well, we look at the world differently than most technicians do. Most technicians are primarily focused on what? Price charts. Okay, flip open the Wall Street Journal and there's the Dow, the S&P with the 65-day and a 200-day average overlay. We plot those charts and put them in our reports, but then below those charts we put momentum charts. Now, by momentum, I don't mean normal stuff you've got on your quote screen that's free. Things like RSI or MACD. You click a little button and it's there. Those are what we call wet noodle indicators. And actually they look like it. They loop up and down. And what we look for is we take price, maybe it's daily, weekly, or monthly, and we plot it against, relatively speaking, on an oscillator, meaning given moving average. So let's say you want to know what the quarterly momentum of the S&P looks like. So what we run is a 3-quarter moving average, which is to say we average the prior 3 quarters. We come up with an average price, including the highs and lows. And we use that number, that moving average, as our axis point, zero line on an oscillator. Okay. Now the market's either above that average or it's below it, in which case we don't lay the average on the price chart. It's a zero line. So you're oscillating the market. Now, by doing that, it sets up structures. That's what we call momentum structural analysis. It sets up structures like any price chartist wants to see on his price chart. Namely, he can draw a trend line under some lows. He can draw a floor, maybe the market's stopping on, holding, or a ceiling. You're looking for structures. Well, we look for the same thing, but on momentum. We find that invariably at trend change points, tops or bottoms, that momentum will usually, almost all the time, lead price in terms of defining a trend change. In other words, breaking down or turning up. It'll usually happen on a momentum chart before it'll happen where everybody can see it on the price chart and get excited. You want to be there before everybody else gets excited, right? Okay. So that's what we do. Now, generally, we look at things on a fairly long-term basis. We don't care so much about the day-to-day. I know that a lot of investors, they're fixated on what happened last hour, today, or whatever. We tend to look at annual, quarterly, and maybe monthly momentum more than we look at things like daily momentum. Now, we also cover all 4 major asset categories. Now, by that, I mean the debt markets, foreign exchange, especially the large foreign exchange, dollar or euro, for example, commodities broadly, but with an emphasis on gold and silver, and the stock markets, including some key foreign stock markets. Now, why do we look at so many things? The reason is obvious, has been a long time obvious to us, that there are many times that if you're in a given market and focused on, let's say, a stock or a sector in the stock market, you've got to be aware that other icebergs are floating around out there, other asset categories. And it's not just what you think is going on with the stock market, but what's going on with the debt markets, foreign exchange, commodity prices. How will that impact your stock position? And those are external factors, but they're very real and very, very big. So you really need to look, no matter which market of those 4 categories you might be heavily invested in, at the other categories, because they'll impact your category. Now, sometimes that connection is sort of loose, where if interest rates go up a little bit or down a little bit, it won't affect stocks or something, but there's times when it becomes acute. And, we're at one of those times now where everybody's focused on what the world is the Fed going to do down the road. And so last week we had this terrifying 5% drop in gold. It took 7 market trading hours, basically, part of Wednesday and part of Thursday, and then it quit. And similarly, it had effects on other markets. We think most of those ripples that we saw aren't sustainable. They were news-based, people chasing headlines. And we think that we're reaching a point now where the connectivity between these big asset categories is getting tighter and tighter to where we could have an eruption in terms of the violence injected into markets. Right now, we don't have that much violence, if you look at it really. The stock market's been going up since 15 months now from the March low. Gold's been rising for several years with $100 and $200 drops here and there, but basically just continually rising. We think the bond market's turned back up, meaning yields back down, which is surprising to most people because they're talking about what? The Fed may be tapering, raising rates down the road, but the bond market's in their face. Rates have been dropping, which no doubt confuses people. Anyway, we think we're at one of those tension points where, and we think the key factor right now of all the four categories is the stock market. Why? The topic of conversation right now is focused on the Fed as if Fed is God, and we know full well that yes, the Fed can have your back for some time, but there's times the Fed totally collapses in terms of its potency. Witness 2000 to 2002 bear market. They did what they could to save it. It didn't help. 2007 to 2009, they did what they could to save it. It didn't help. And similarly, I think the next bear market, which likely will begin arduously, not rapidly, not like last March. That was a rare situation. Most bear markets start like arm wrestling. It's not real clear who's winning. Over time, you say, oh, gosh, we're 10% off the high. How do we get here? Watch the stock market, because if it starts to fade, and we think we're near a top right now, we think maybe it's going to top probably next month, early in the month, probably at or around where we are now or a bit higher. If it starts down and gets down, let's say 10% off the high in the S&P at some point a couple of months after the high, what's that going to cause? A whole new conversation, because the stock market has not been a negative factor for the Federal Reserve for the last year. It's been a positive. So they haven't had to worry about the ripple effects of a weak stock market, affecting psychology, affecting consumer spending, affecting hiring, et cetera, et cetera. If suddenly the stock market becomes a negative in terms of downside and change in people's outlook, which is not a topic of discussion right now, but he's thinking the other way, okay, then the discussion about whether the Fed is going to taper will go out the window. Because if the Fed perceives, and the public perceives, and investor asset managers perceive that the stock market is risky, and we better start moving assets to other categories, which they're already doing, by the way, then the Fed has a problem, because the stock market could affect all those little economic numbers they're looking at, unemployment and so forth. And so any talk of tapering, out the window. If anything, it's going to be more foot to the pedal.
Absolutely. And that's really interesting, because obviously the stock market's done nothing but go up for the last decade at least. And it's, really high right now. Whenever I see a chart where something's just a hockey stick to the top right corner, I say, I just don't want to touch it. And that's exactly where it is right now. A lot of people are jumping on the bandwagon though, going all in, going into the stock market because they like chasing things high. But this could align with, some softness in the economy that no one's expecting, like you're saying, the need to stimulate more, and that could cause a scare in the stock market. But what are you seeing as kind of a vulnerability or a weakness in the stock market right now as an indicator that you look at?
Well, we look at all obviously the key major indices, like the Dow Industrials to a lesser extent. S&P 500 is on their front windshield. But especially now, for the last several years, the leader of the market has been the NASDAQ 100. And if you look at the weightings of the symbols they hold in the NASDAQ 100, and this is even true with the S&P 500, you'll find that symbols like Microsoft, Apple, Amazon, Google, et cetera, Facebook, have so much weighting that all the other 450 stocks in the S&P 500 or the other 95 in the NASDAQ have such little weighting compared to those. In fact, those 5 symbols constitute almost half the weighting of the NASDAQ 100. Okay, that said, it was the leader on the upside. Now, it's not the leader now, because the spread relationship between the NASDAQ 100, which was outperforming the S&P through last summer, that ended in February of this year. The NASDAQ basically stopped. I think it's nudged a new high recently, but basically its rate of increase is stalled, whereas the S&P kept going up. So when you plot a relationship between those two indices, you'll see that the NASDAQ was gaining in performance for the last year or two vertically in a blow-off pattern, like its price did last summer. It went blow-off vertical. Blow-offs are usually the end of a bull market. if you had a lot of time before. We certainly had a lot of time. In fact, we're in the dozen years of upside. 2009 was the low. If the leader has lost his relative performance to the broader market, the S&P 500, and the leader has technical vulnerability, then when the leader goes down, the rest of the market's going with it. Now, this was true in the dot-com top. No, the S&P didn't collapse 80 some odd percent like NASDAQ 100 did in 2000 to 2002, but it went down 50%. Okay, so we think if we top now and we're close to the numbers, in fact, the S&P and the Dow are going to inherit the numbers just when they open next quarter, because the number that breaks their structure or momentum is actually above the market. It's hard to explain why, but it is. And if they go down, and we think they're vulnerable for initially a 10% drop once they break our numbers, and we define those in our reports. If they go down 10%, you know that NASDAQ, being weaker now than the S&P, is likely to go down more, maybe 12, 15%. Problem. Our work on NASDAQ 100 says you can't go down next month about 6 or 7%, because if you do, I'm going to blow, again, I described structure. We're going to blow a momentum structure that goes back 12 years. It's a ceiling that had been on the momentum charts. You'll break back through it. And then that'll be our first sell signal for NASDAQ. When the NASDAQ turns down on a net basis, it's turned down on a relative performance already, but if it turns down a net trend where people start seeing it in the price even, at that point, sentiment's going to go rapidly the other way. What's interesting, when we measure the alternative markets, and right now the two best alternative markets to the stock market are what? Gold and T-bonds. It was certainly true as the market collapsed last year. And prior to that. So what happened? Gold went down from last August high through March of this year, while the S&P continued up. So they were negatively correlated. T-bond market went down in price, up in yields from a high weekly close when? Last August, coincident with gold. Went down in price to what? March low. Now, bonds didn't come up off their low until about 2-3 weeks ago, but they stopped in March, basically coincident with gold. Gold turned up a couple $100. Right now, it's about 120 off that March low. And bonds have now turned up, meaning drop in yields. What does that signal? It says to us that probably large asset managers who've been around a while, not novices, don't chase trends. They're skeptical at times, sometimes the appropriate time. Guys like Ray Dalio, who's warned us, don't be so worried about the price of your stock. Worry instead about the value of your money. Okay. Guys like him who are not gold bugs have shifted assets, no doubt, not lots, but marginally, let's say, over to safer places to be. And I see the evidence now in what the bonds have been doing for the last several weeks and what gold's been doing since the March low. So that indicates to me that large asset managers who are skeptical have begun to move slices of their assets from one to another. Now, if the stock market starts to get more overtly weak, you're going to have more of that because they got to go somewhere. Okay. And it's obvious that if they're buying T-bonds, they're not buying it for yield. Okay. They're buying it for safety. And they're buying gold because it's a leader of the inflation event. It led the commodities up 2 years before they even turned up. So anyway, I think that's going on. And that's another reason why you should look at all four asset categories, because they'll impact each other.
Sure. So in the event the stock market does kind of have a massive correction, normally the Fed can just, they have some tools in their toolbox, or they either lower rates or they print, and that just causes stocks to just rally right back up. And it seems like that's what a lot of people are expecting or pricing in right now. Do you think it will be a problem for them this time?
Yeah, it will be, because ultimately the Fed may create the river flow, but investors as a class divert the river flow to where they want it to go. Now, in 2009, at the bear market low, when the S&P had been cut in half, more than in half, from 1570 down to 670, the stock market was arguably cheap. In fact, we got very bullish on the very bottom week. We said major low. Okay, not because we love stocks, but the technical said this is it. That was the end. At that point in time, then the river flow that the Fed had already been creating, but which did not stop the big bear market, went into play. And so people bought a lot of things. They bought the stock market and they bought gold as well. And for the next several years, gold went up more than the stock market. They were coincident at the time. But in 2011, they divorced. Gold peaked, went down, S&P continued on up. But at that point in time, it worked. The Fed printing money worked because the market had been cut in half. So investors perceived less risk, greater reward. And so the river flow, they diverted it where the Fed actually wanted it to go at that time. But now we've been going up a dozen years and you have this upwardly curving chart off the page, one of the oldest bull markets in history, no doubt supported all along the way with easy monetary policy. Now off the page, easy monetary policy. But the question is, will investors and asset managers perceive this to be forever upward? Or are they smart enough to know, no, there's times that, the Fed doesn't control, because they look at history and they know. If they were there in 2000, they know the Fed tried, it went down. Okay. We think we're at that point now. And I think that if the market starts to go down and they create even more river flow, or they simply continue what they're doing, the flow won't go where they want it to go. It's going to go into other asset categories. We think primarily it's going to go into gold and silver. Probably some of it will go back into Bitcoin at some point, not right now, though that's going to take a while to rebuild that market. And commodities are not temporary in the upside. They may look like it for the moment. Like Powell conveniently pointed out lumber, which the top week we said this is it. Lumber was an exception to most commodities. It went up way before they did because of peculiar reasons unique to lumber, not to the broad commodity category. And it's since collapsed more than 50%, and it's not likely to ever go back to that high. But most commodities are different. They moved as an asset category almost in synchronization starting last November. That's when we turned bullish on the Bloomberg Commodity Index. And sure enough, within a month, either side of that, corn went up, soybeans went up, wheat, all exploding coincidentally, sugar, copper, oil made a low and came up through $40 in last November, and we got very bullish at that point. It's now 74, I think. So the commodities all turned up coincident, meaning it wasn't peculiar to each market what caused the upturn. It was the monetary policy. And if the stock market wobbles now, it becomes a threat, that monetary policy is going to continue. And we still think it's going to go into the freshly upturned commodity category. Because when we measure commodities like the Bloomberg on an annual momentum basis, it only just broke out. And usually annual momentum trends, when they turn, last for a handful of years. For instance, the last time we made a major turn in the Bloomberg was the top in 2011, coincident with gold. It didn't quit going down until last year. So quite a few years of downside. We think the same is going to be true on the upside, except it may be a little more compressed this time. Instead of taking 5 years, it might get something big done in a couple of years. And we're also of the working assumption that this trend that's about to emerge in these categories is not going to be incremental. It's going to be compressed because of the very nature of what's underlying it, the monetary policy, which is, again, off the page. Such that gold at some point, which has been, for example, an incremental upside, 1054 low in 2015, went to 2000 double basically. But if you look at it carefully, it really never went crazy. It would have a couple $100 burst, then a pullback and fool everybody, and then a couple $100. It was always sort of a staircasing ladder effect. So it was incremental. What I mean by a chaos theory type of move, which is what we're looking for, was something that silver did last summer. Silver broke out on our work at price of $19.48, come up through that price. It blew out an annual momentum base that went back up 5 or 6 years, just a great big flat base you could see. It went up 50% in 3 weeks. That's what I mean by non-incremental. And I think we're going to see more of that type of thing in the next year, year and a half. Not necessarily right away, but it's going to be an interesting year, year and a half, we think. That a lot of stuff is going to move big time between now and late 2022.
No, it sounds like it. So this is a bold call because, in the past, last decade, every time there was a stock market correction, silver and commodities would just, correct even more than the stock market itself and continue to underperform. So you see kind of a shift away from that, a divergence where stocks will underperform, commodities will outperform. Will it like the 70s?
Yep, similar, except I think probably even more exaggerated. First off, if people will stand back and really do their technical homework, and I'm just talking even just price. Look at the Bloomberg Commodity Index between 2000, 2015, big up till 2011, 2007 or 8, then it dropped. Then 2011 made a secondary high and it collapsed. What was the stock market doing then? It was going up. There's 5 or 6 years, Bloomberg going down, being suppressed to the point where it can't go any lower, just laying in the mud, so to speak, since 2016, and stocks continuing to go up. So the argument that they're the coincident trends, no, they're not. Yes, we did have a coincident trend in March of last year, where, for instance, the gold miners collapsed coincident only in the last 5 or 6 days, by the way, of March, when the stock market was collapsing. They ignored it up to that point. They joined in with the stock market crash. And so people think, see, they're correlated. Well, that was an extreme event that is not likely to be duplicated again. And it didn't last. Because as soon as it was over, gold miners went ballistic on the upside, even more so on a percent basis from the March low to the recent highs than did the S&P from the March low to the recent highs. So again, we don't think there's a coincident trend. Go back and look at August. It was S&P in August. It was way below where it is now. Where were the gold miners, and so forth, the silver back then? They all dropped while the stock market went up. So we think that fear is nice to have because it keeps the long skeptical. But frankly, I don't want the longs too enthusiastic until we get into that chaos period where it's going vertical. Then they can get enthusiastic, if you know what I mean. Okay. Yeah. But each time we get these kind of breaks, people are scared to death, thinking, my gold's going to go down with the stock market. This time, we don't think the stock market's going to crash. We think it'll go into a normal bear market, meaning where you can debate it. For the first 6, 12 months, you're still wondering whether it's a bear market or not. But there's no emotional moment like we had last March. And I think you'll see the opposite markets, the alternative markets rise.
Yeah, that's absolutely fascinating. And just thinking about how that could align with kind of the macro narrative. Could it be an inflationary scare? Could it be a loss of confidence in the dollar and the Fed's ability to pump up stocks and therefore a flight to value like commodities? It's interesting, right? Because I don't know, because you look at the technicals, but I just wonder how
I think the fundamentals will change. And that one thing you just said, confidence in the Fed. I think we're headed for a crisis that will create doubt about whether we want a Fed. And we may even have comments from Europeans, Germans especially, about whether they want the ECB. In other words, this stuff hasn't worked, okay? Nixon cut us off, the dollar off from international exchange for gold. It was already domestically cut off, but in 1971. And, have the events over the last 50 years really been that good in terms of stability and so forth? Has the central bank really kept things copacetic, or has they contributed to the boom-bust cycle, which I would argue they're the main contributors to the boom-bust cycle? By creating too much one way, they create too much the other way. I think there's going to be some intellectual doubt from various parties about, hey, this hasn't worked. And we may even have examples from what a world we live in, where former communist countries, China is no longer really communist. The party rules, but it's not what it was under Mao, or even Russia, where you have currencies backed by gold, or they're non-fiat currencies to some extent, meaning the government doesn't have control how much money there is. Like even Bitcoin, it can only grow so much. It's very finite compared to what the dollar can do in terms of the quantity of units. I think this next crisis we're headed for will create a wave of intellectual doubt among academicians, economists, and possibly even some ex-Fed people who say, hey, this really, it hasn't worked out. We need some other way to have money. We don't need top-down control. So that's just a notion on my part, and I think the events may help precipitate that.
Yeah, absolutely. So a crashing stock market will certainly anger a lot of people and make them start to question, the system at B. I mean, right? That would just, I think that is right now. I feel like the Fed's been able to kind of dumb down people and pacify them with a rising stock market, rising 401k. But if that ends, that's when all the big questions are going to come into place. And it's incredible that you are calling for kind of an end to the perpetual bull market in stocks. It could be like Japan, like a lost decade almost.
Yeah.
I think.
It's now, it doesn't have to be a collapse in the stock market. We don't think that's necessarily the case. Ultimately, it take two years or so to maybe down 50% or something like that. Let's just argue that. But in the history of 100 years of history of the stock market, using the Dow back in the early 1900s, and S&P began in the 1950s. If you go back 100 years, you'll find that no bear market except one ever began with a crash. 1929. And even it had a 50% rally back to the high by the spring of 1930. And then it went into a 2-year bear market that was arduous, which had never crashed. It just went down like an arm wrestling match. Devastating percent drop. Look at the 2000 top, 1970s top, dropped into 74. There was no crashes. Maybe at the tail end, you got some emotion, but you didn't start with a 35% drop in 3 weeks. Those events normally don't lead to bear markets. 1987 is an example. You had a crash. Within a couple of weeks, you had a 30+% drop. It was a low. It went up for the next couple of years. Okay. Same thing with the 2000 top, 2007 top. They didn't begin with crashes. And that's what we expect this time is an arduous downturn that gets noticed, but it doesn't generate margin call fear and that kind of emotion. It just causes shift in the river flow because investors change their preferences.
Wow. Okay. So great. So it might be wise to look for the undervalued assets right now, like gold miners and gold and precious metals.
They're still undervalued despite the recent upturn. Yeah.
Yeah. Commodities, oil stocks, incredibly undervalued. So you're bullish commodities overall.
Bullish commodities overall, but with the caveat that don't expect commodities except here and there bursting, to the upside, quick shots. But in the long run, we don't think commodities will maintain a pace with gold and especially not with silver. We think that percent-wise, yes, commodities are important to look at. And if you've got to be in stocks, well, then, like you said, oil sector stocks, which we prefer over oil. In fact, back last November, if you'd bought what we suggested, XOP and OIH, the two oil subsector ETFs, they've done a lot better than oil on a percent basis.
Absolutely.
They were vastly undervalued. So there are places in the commodity category, such as stocks like fertilizer stocks, going up with the grain markets that have done better than the grains, and because they were vastly undervalued as well. So yes, there are areas there, but we think the leadership will be maintained by gold and silver in terms of percentage gain. The dollar is also a factor that come into play soon. It's already in a bear trend, we think, because we got bearish at a price of 99 back in early 2017. Right now it's 91 and change. It's been the quietest 5-6 years in dollar index about its history in terms of percentage volatility, about 12-13% range, very small. Same with the euro the other way. If the dollar drops back down, dollar index now, drops back down to 90 one more time, and it's been there a couple of times in the last 2 years. If you go back down and touch 90 one more time, it's 1.5% under the market. We think it's going to flush again. We're going to flush down into the 80s. Now, that'll become a factor again, too, because foreign exchange, which has been very dull on a percentage basis, major foreign exchange, euro and the dollar, are suddenly going to get volatile again. And, of course, a weak dollar, assists what? Should assist gold, be more evidence at the back wind of gold and commodities.
Yeah, that's so good to know, but it's hard for me to get my head around because I've seen commodities kind of just track the stock market for so long or underperform. But in the 70s, when there was an inflationary scare, you're saying like grain and other commodities spiked while stocks crashed, right?
Stocks didn't crash so much. They'd already dropped in 1974 and they leveled off, but they were a wasteland in terms of an investor. They were up and down basically until 1982. While commodities, went ballistic. Gold went from $103.50 at the August low of 1976 to $850 in 1980. Much of that coming at the tail end when it went ballistic. While the stock market was a wasteland. I was a futures broker back then, and I remember when I go into the office, half the stockbrokers weren't even in their cubicles. No business. Okay, phones weren't ringing. It was a depression for stock people, whereas commodities were doing great. things change, and I think we're going to shift back that way again. And I think you could thank the Federal Reserve for that, for the last decade or so, creating the conditions that will cause that river flow change.
That's incredible. So yeah, obviously chasing the stocks at their highs right now usually isn't a good idea to chase anything at their highs. So stocks right now makes sense. So great. So contrarian. So then thinking back to another call you made about Bitcoin, right? Because you nailed it, right? Right. A few months ago, you said, look, I see weakness in Bitcoin. You were not bullish. It's corrected, I think, almost 60% at this point. So what is your commentary on that? How could you foresee that? And what do you see happening now?
Well, Bitcoin is hard to fundamentally analyze, right? Because, it's hard to get your mind around. But basically, it's a currency that can't expand infinitely, unlike most fiat currencies. The ECB, the euro, they could expand the quantity. The Bank of Japan is great at doing that, hasn't helped their economy. And the Fed has now learned how to do that full throttle. Okay. The cryptos, at least the private cryptos, because we're going to have some governmental cryptos pretty soon probably, and they could be fiat equivalent. Okay. They can't expand infinitely. Therefore, to some extent, they are competitors in terms of store of value. And we think that ultimately, yes, Bitcoin and perhaps a few others will survive and actually be institutionalized in a sense, that common usage. Right now, it's still experimental. It got too crazy. We were bullish. Our history of Bitcoin is when they were legalized, not legalized, when it started trading on the Chicago Merc, December 2017, there were 20,000. We argued it would crash and go to 5,000. Why? Because it was a bubble. We could define it as a bubble. It did. It went to 3,600 ultimately. Took it a year and a half, but it did. After that, came back up through 5,000. Basically, from that point on, everything long-term technical said positive. Got up to 65,000 early this year. But in the process of doing that, it had built a structure that we could see on momentum. You could not see it on the price chart. It was like a line in the sand that went back a couple of years. And when we came down in March, we approached that structure, tried to rally, and we argued on the week of April 23rd that if you close that week at 59,000 or lower, it's over. The next drop would take you to the upper 30,000s to 40,000 area. Well, it did. It took us there pretty quickly. It was a 2-week rally after it broke our numbers. It tried to rally back up, and the rally high was 59,000. And then it collapsed down to into the 30s. And the weekly closes for the last 5 or 6 weeks have all been like 36,000, 37, 38, so the upper 30,000s. So tried to hold our zone of possible support. But we argued we weren't certain that would hold. It was support, but we didn't know that it would hold and create a turn that would be worth calling a turn. So now we've plunged below 30,000 intra-week, and we suspect there's more weakness to come, but not a lot. Because I think you've basically seen the worst. The problem with Bitcoin, technically speaking, that breakage was so severe in terms of long-term momentum technicals that you're not just going to turn Bitcoin back up and go back up again. You're going to turn Bitcoin back up and you're going to do some flip-flopping, base building. So you're going to have some swings, trading swings that you could probably trade both sides of over the next 6 months while Bitcoin rebuilds itself, technically speaking. And then maybe next year it might start back up again. But we don't think you're just going to go back up and go to 100,000 this year. I've heard some commentators say that. Technically speaking, we think that's impossible almost. So we think Bitcoin's broken, but it's probably near a low. I would guess, not far below where we've been already this week on the high 20s. And then you're going to have to build your way out of here. And that's going to take some time. And so don't expect if you buy Bitcoin at a good low that you're going back to the highs. Highly unlikely for a while.
Okay, so it'll take some time, but do you think that it will be similar to gold and gold miners in a way that people will rush into it to escape kind of the inflation and the stock?
I think it's already been perceived somewhat like that. Yeah, I do. And I think it's also an intellectual thing that we talked about, the demise of the Fed. Well, if you're buying Bitcoin and you understand what it's about, or Ethereum or whatever, you understand it's a money unit that can't expand infinitely, and therefore you intellectually differentiate it from government money. And once a generation of people, a lot of these are young investors, grasp that concept, it's also an implicit distrust of government money. And so without going to a classroom with some libertarian professor explaining that to them. Okay. They've learned it on the ground. They've learned a basic concept that we think is valid. And I think that in itself is sort of almost revolutionary because it can overturn a lot of notions that the older generation still believes in. And we think a lot of these things are going to go by the way, and Bitcoin is sort of a tool in history of that event.
Yeah, it's actually incredible seeing, as a long-term gold bug, I've talked to a lot of, long-term gold bugs. It's incredible seeing Gen Zs talking about how the Fed is printing money, cash is trash. Like, that's why we need Bitcoin. Normally people go to gold, but it's just so incredible that a bunch of young people have caught on to that.
Well, they'll figure also, you remember there's a recent popularity with silver.
Yeah.
Okay. And I think that's going to continue. In fact, there's been a lot of buying of bullion, just raw silver by a lot of young investors who are not speculating. They're not going out and buying something they could sell on the phone 5 minutes later. They're buying it, having it physically brought to their home, put into an iron box in their basement or something, taking a picture of their wife, putting it online with all the silver bars, that's becoming popular too. So I've said this before recently, and it wouldn't shock me that silver becomes the next Bitcoin in terms of the upside dynamics. It's the poor man's gold, they call it, but I think a lot of the people in crypto, especially after being gut kicked recently, while they've not given up intellectually on the notion of Bitcoin or market-wise, they've also perceived that, hey, these gold silver guys aren't crazy. They're not a bunch of old fuddy-duddies. There's actually something to be said for that. And they've gone into silver. And I think that it wouldn't shock me that if silver re-engages out of this recent range, it's really been a range for silver, not been a decline. In fact, I'll give you a number. You get back over $28 again on a weekly close, and we were above there several weeks ago. You do it one more time, this time you won't stop. You'll re-engage silver. So that's going to be interesting. But Bitcoin has its place in history, and it will continue, I think.
Absolutely. So there's a place for Bitcoin, there's a place for gold and silver as stores of value in the long term. Great. So that's really good to know. Thank you. There's been this debate raging between the deflationists and the inflationists. Deflationists think the commodity boom is transitory and that technology is going to continue to be deflationary and just, buy tech stocks because it's going to, eat the world. The Fed's going to be able to suppress interest rates. You're on the other camp, which thinks that, no, this is a much bigger structural deal. And I think you explained that pretty well. So thanks so much for stopping by.
Thank you very much. Thank you.
Yeah, absolutely. So where can people go to learn more from you?
Well, our website is olivermsa.com, MSA for Momentum Structural Analysis, olivermsa.com. We've got some samples there, explain our methodology, and you can request sample reports.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.